The purpose of this video is to present a realistic comparison between the offering of prop firms and what Darwinex offers to traders. There's a perception by some traders that prop firms offer a better deal than Darwinex. How do we know this? Because we often get asked the question, why does Darwinex only pay 15% when prop firms pay 80%? And yes, these are two percentage values that often get quoted. However, they are values that can't be compared like for like. It's similar to comparing apples with bananas. You can't do it. What I'll illustrate in this video is that the offering from Darwinex comes out head and shoulders above what any prop firm offers. To explain the full picture, I'll need to split it into two separate comparisons. Firstly, I'll look at how prop firms compare with any standard regulated broker, of which Darwinex is of course one, but there are also many more out there. And the conclusions of this first comparison will surprise many of you, I'm sure. After we've laid the foundations with this, I'll then move on to the significant additional value add that Darwinex offers to traders. But before I can do either of these, I need to make sure everyone has a good understanding of the most common prop firm business models. The example I'm going to work through in this video is based on a real prop firm, one of the biggest. This prop firm had the concept of immediate funding, meaning that customers didn't need to undertake challenges or verification stages before being allocated trading capital. With this prop firm, the initial fee was just a little under $500, but I'm going to use around $500 in this video to keep the calculation simpler in the examples. And for this $500 fee, traders were immediately given a $10,000 account with a restriction placed on it in the form of a maximum allowable drawdown of 5%. Hit this drawdown and you lose your fee and you have to pay again if you want to restart. But this is just one example, and I think it's important to make the video applicable to other prop firm models also. So although I'll use the no challenge scenario as the main example, I do want to explain how the model differs when there are either one or two challenges, sometimes called verification stages, that traders need to overcome before being allocated any capital. The first thing you'll notice is that when there are challenge stages involved, the prop firms charge a smaller initial fee than in my example, even though when a trader gets through the challenge, they receive a similar prop size account to the example I'm using, with similar restrictions also, such as the maximum allowed drawdown percentage. To understand why this is the case, we need to consider things from the perspective of the prop firm and the business model they use. Prop firms know from experience the approximate percentage of traders that will fail the challenge process. For example, by hitting a certain drawdown or violating some other restriction that they've put in place. Every trader that does fail, of course, will lose their fee and not be able to move forward to make any money from the prop firm. So, as an example, if only 20% of customers manage to pass the challenges and go on to have a chance of making money, then the prop firm can charge just 20% of the $500 fee, $100 in this case. And despite charging this lower fee, they can still allocate a similar size of prop account as in my example, with similar restrictions. This of course is because the prop firm is still making the same amount of revenue from the fees per trader that receives a prop account. Both scenarios are equally appealing to a prop firm from a financial perspective, and more than anything, the difference between no challenge, single challenge or double challenge prop accounts merely comes down to the way they market their offering. This brings us onto another really important point about the prop firm business model. 5% drawdown on a $10,000 account is of course $500, and in our example this just happens to be the same as the fee the prop firm collects either from each customer in a no challenge setup like our example, or what they take collectively from multiple customers where there is a qualification challenge and many of the traders fail. That's not a coincidence. To put it plainly, the prop firm is using the trader's money in the form of the fee they've paid to cover margin on the account. This means that 100% of the risk is on the trader, while the prop firm carries zero risk, even if the trader hits their drawdown. Let me explain this slightly differently because it's important. Many prop firm clients have the perception that the prop firm is actually investing their own capital in them and their trading strategy. Why do prop firms give the impression they're doing this? Because it tends to make clients feel good. It makes them feel like a professional trader or a hedge fund manager. But unfortunately, as we've just seen, the prop firm isn't really risking any of their own capital at all. What's actually happening is that the prop firm is simply using the client's own money in the form of the fee that they've paid to provide the margin on the trading account, thus eliminating all of the prop firm's risk. This is a really important point to understand. Now, there are of course many other variants of prop firms with different costs, restrictions, drawdowns and so on. But the general principle is that if they increase the restrictions, then it means more people fail, and they can then reduce their fees further. But the bottom line is that the prop firm will always know what they need to charge based on the customer failure rate, which in turn is determined by the specific rules and restrictions they use. This means the prop firm can always engineer their offering so that they eliminate their risk entirely when averaged out across their customer base. Even though I'll just use this one real prop firm model in the remainder of the video, hopefully you'll now be able to understand how this translates to alternative prop firm models. So now on to our first comparison, prop firms versus standard brokerage accounts. Having seen how the customer's $500 fee was used by the prop firm, let's now try to keep this as like for like as possible. And so in the brokerage account, we'll use this same $500 amount, but this time as a deposit for the trading account. And remember that this still belongs to the trader, it's their money, and so if they want to, they can withdraw it at any point, which of course is not the case with the $500 fee paid to the prop firm. I really do want this video to be as balanced a comparison as possible, and so where there are benefits of a prop firm model, I want to talk about these. And one advantage of the $10,000 in prop firm accounts compared to the $500 in a brokerage account is concerning the account margin that's available to the trader. Clearly, this is higher in the $10,000 prop account. So in terms of purchasing power of the trader to open larger positions, this is definitely an advantage of the prop account compared to the lower purchasing power available in the $500 brokerage account. But, and this is a big but, this is also a double-edged sword. If you take full advantage of that purchasing power and the leverage that the prop firm makes available to you, then there's an incredibly high probability that you'll violate the drawdown that the prop firm imposes and lose the account, even if you have a strategy with a good edge. Taking full advantage would mean the volatility of equity fluctuations will simply be too high. So the bottom line here is that yes, with the $10,000 account, you will have more margin and therefore more purchasing power. But if you want to avoid hitting the drawdown, which clearly you do, then you can't reliably take advantage of it. Building on this argument, it means the leverage that you can safely use is always constrained on the drawdown limit the prop firm imposes. So if you have a genuinely good strategy with a real edge that will succeed in the long term, then you have to use a level of leverage that means you'll never hit that drawdown, and this leverage is far lower than the prop firm is actually making available to you. So even if you're given 100-to-1 leverage on paper, you can probably only sensibly use 10-to-1. And this has the effect of equalizing the purchasing power between a standard brokerage account and a prop account. So you have to remember this, just because they give you more leverage, it doesn't mean it's sensible to use it. As I said, if you do decide to take advantage of it, there's a very high chance you'll hit their drawdown restriction, sometimes as soon as the first or second day of trading. And then of course you've lost the fee you paid, and if you want to restart, you have to pay again, so the prop firm benefits. So with the sensible amount of usable leverage being similar between the two accounts, combined with the fact that the maximum monetary loss that will have a catastrophic effect is also identical on both accounts, $500 in this example, both of these accounts have to be traded in the same way as a normal $500 account would need to be traded. The fact that there's an additional $9,500 below this in the prop account becomes rather irrelevant to the trading decisions and position sizing strategy that needs to be employed. And the fact that this $9,500 is irrelevant is just further indication that prop firms are not really investing their own capital in the trader, as we discussed earlier. So the reality is that we have this in both scenarios. You're effectively trading in the way you would need to with a $500 account in both scenarios. There are a few additional differences that you need to be aware of. Firstly, in the brokerage account, you can choose a highly regulated broker like Darwinex, who is bound by the procedures and practices of their financial regulator. So your money is protected in segregated bank accounts and so on. Prop firms are not regulated in the same way, so you have to answer the question for yourself, is your investment in them as safe? Furthermore, as mentioned previously, different prop firms impose different restrictions in order to turn the odds in their own favour. So restricting some types of EA usage, for example, or banning trading during high volatility events. They'll all be slightly different, and there may be others that you'll need to investigate to get the true picture. But with a broker, you're free to trade as you see fit without these restrictions imposed on you. So now let's turn our attention to the interesting part, making a profit on the accounts being managed. And this is where the brokerage account really does come out on top. Let's use an example where over time, two traders, one with a brokerage account and one with a prop account, both trade in a similar way, both being cognizant of the fact that they can't lose more than $500 or it's all over. So they both size their positions in a similar way and manage to successfully deliver a profit of $150 on their accounts. What happens next? Well, for the trader who has a brokerage account, 100% of that profit is theirs to keep. Remember, this is their money. But unfortunately, the prop firm customer doesn't come out quite so well. Remember that prop firms profess to give you 80% of any profit you deliver. So here, the trader earns just $120. Hopefully you can see here that rather than being given 80%, when you compare this to the brokerage account, what's really happening is the prop firm is taking 20% of the profit the trader has generated. So as you can hopefully see, there's quite a large disparity between how the prop firm markets this 80% figure and what it means in practice. Clearly, in this illustration, a standard brokerage account comes out on top. And remember, we haven't even started to look at the Darwinex value add offering yet, or talk about what the 15% figure refers to. This is just a comparison with an account from any standard regulated broker. Before we move on to the Darwinex model, let's quickly summarise. The prop firms are not really giving clients their capital to trade. This is merely a perception they like to give because it's in their interest for clients to think this is happening. In actual fact, they've engineered the fee structure so that they are not risking any of their own capital at all. It's the fee the customers have paid that provides the margin on the trading account. Next, when compared with brokerage account customers who get to keep 100% of their profits, the prop firms are effectively taking 20% of the profits the customer has made. So the prop firm clients end up with less money than a trader using a brokerage account. Remember how prop firms market their offering as giving the customer 80% of profits. A more accurate description is that they allow customers to keep 80% of their own profits. Now, of course, there will be a small number of traders that do make a lot of money with a prop firm. But the point is that if you total up the results from all of the clients, then on aggregate, the prop firm is taking 20% of their profits. Prop firms make much more money than a broker does, and this, of course, is unfortunately paid for by the prop firm traders on average. But to keep things balanced, there is this advantage of prop accounts. With a standard broker, the purchasing power you have reduces if you lose and your account balance reduces. But this doesn't happen to the same extent with the larger prop firm account. But, as I said, traders need to be very careful because prop firms typically offer higher leverage than a brokerage account, which can increase the risk of hitting any imposed drawdown limit significantly. So for sensible traders with a good strategy, they'll probably stick to 10-to-1 leverage anyway, and this then has the effect of equalising the purchasing power between broker and prop firm accounts. So let's now move on to the second comparison, prop firms versus Darwinex. Remember, the previous comparison is applicable to any credible regulated broker, and so it also applies to Darwinex. And so based on that, you should hopefully agree that Darwinex is already ahead of a prop firm in terms of its appeal to a trader. But of course with Darwinex, there's a significant value add. I started this video by saying we often get asked the question, why does Darwinex pay 15% when prop firms pay 80%? But you should hopefully now understand that this 80% isn't all it professes to be. And what about the 15% that Darwinex talks about? How does this fit in, and how does it affect the bottom line of what a trader can potentially earn? In the Darwinex model, there's a fundamental difference from prop firms. Here, your brokerage account is separate from any investment or seed capital you've managed to attract. So a trader simply trades their brokerage account in the same way they would regardless of whether they've attracted any investment or not. Then Darwinex takes their trading decisions and uses them to trade the investment capital as part of their role as a regulated asset manager. It's not quite as simple as that, as there's a sophisticated risk management process that's used to regulate the risk of the investment capital to firstly protect investors and secondly to normalise the risk of indices from different traders. We have many videos that explain this in much more detail, so I'm not going to cover it here. But to make the examples easier to understand, I'm going to assume this trader is using a medium level of risk and the risk engine isn't having to increase or reduce risk, meaning the percentage profit made on the investment is approximately 1-to-1 with the percentage made on the brokerage account. So as an example, let's say that a trader has been successful in receiving a capital allocation of $30,000 in this month's Darwinia Seed Capital Allocation Programme. I've used $30,000 because this is the starting amount for anyone who's successful each month. Allocations do get much larger than this the higher up the leaderboard you finish, but $30,000 is a good value to use as a starting point in our example. If the trader now subsequently grows their own brokerage account by 10%, because we're assuming the risk manager is operating at 1-to-1 risk, this means that the $30,000 in the capital also grows by 10%, generating a profit of $3,000. And this is where the 15% figure comes into play. To reward the trader for the profit they made on the seed capital, they get to keep 15% of that. So in this case, that equates to $450. And don't forget, we saw previously the fact that the trader gets to keep all of the profit on their brokerage account instead of the prop firm effectively taking 20%. So even though Darwinex was already ahead, they're even further ahead with this additional 15%. If you think about it, the trader has earned an additional ROI of 90% compared to trading a standard brokerage account alone, meaning this type of model is significantly more beneficial to traders. Or to put it another way, they've earned 10 times the profit they would have compared with the brokerage-only account. But remember, this is the smallest Darwinia seed capital allocation amount offered, $30,000. Allocations get much larger the higher up the leaderboard you finish. Furthermore, Darwinex is not just about seed capital. As an asset manager, Darwinex also manages third-party investor capital and allows traders to attract that based on the performance of their trading strategies. So let's now consider a trader who has a good, established track record and has been successful in attracting 1 million of third-party investment capital. At the time of recording this video, there are over 20 traders that have in excess of 1 million on the platform, the largest of which has 33 million. So 1 million is certainly a reasonable figure to use as an example. This 1 million is actual third-party money invested and trusted to the regulated asset manager, Darwinex. But the trading decisions are coming from the trader, since this is what attracted the investor in the first place. So now, if the trader generates 10% profit on this investment, this equates to $100,000. And the 15% that the trader earns now for their skills is $15,000. And all of this could have been done on a relatively small brokerage account, as we saw before, meaning the overall ROI for the trader can be significant. Note that in addition to the trader making 15%, Darwinex also receives 5% for providing the service of the regulated asset manager and for the platform to enable all of this, which means the investor pays a total of a 20% performance fee. This is in line with the norm for hedge fund models. Of course, it's only right that the investor gets to keep 80% because they are putting the money up in the first place. So to summarise, standard brokerage accounts are better for traders than prop firm accounts. Traders get to keep 100% of their profits instead of having 20% taken away. But Darwinex adds an additional value add compared to the standard broker. This gives traders the chance to increase the ROI on their trading capital significantly. To find out more about Darwinex, visit darwinex.com and see a link to our YouTube channel on screen now, where you can find videos explaining more about Darwinex.